Oh, there he is. There he is, the king of blog. Hey, Peter, I'm going to let you. So we have Peter Beanland. Peter is on our Ignite. I have like potato chips in my teeth, Rob. I'm sorry. Where's Myrtle? Where's Myrtle before we get started here? Is Myrtle here?
Unchained Fury. I don't know where she is. But I think that was Jake's nickname at University of Wisconsin basketball, Unchained Fury. But if she
Oh, that
wants to
was
apply,
Nick. That was
I will
Jake's
snag her.
nickname, Unchained Fury. I love that. I love that. Well, I want to introduce Peter. Peter is on our Ignite exec team. He's one of our coaches and he's one of our amazing, amazing branch managers. We are so fortunate to have Peter. And Peter's going to introduce you, Rob. And we had a ton of people write in with questions for you. So we're really excited about this session. And again, feel free to put it questions you have into the chat. We are recording this. Again, everybody's asking me, will we get slides or we get and we're going to let everyone know where to follow Rob too, if you're not already reading his daily updates. So Peter, take it away.
Yeah, thank you. And hey, Rob, thanks so much for joining us. We are beyond excited that you're able to spend some time with us. And here's how this is going to roll, folks. It's going to be kind of a question and answer period for Rob. So if you're interested in knowing what's on Rob's mind, put your questions in the chat box and we'll get to them. We had thrown out the cast of that net a few days ago and got an incredible number of questions. And to Sarah's point, the number one question was, how is Myrtle? Right? You must mention her often enough. I'm super excited to have this interview. I've been reading your daily update for about 10 years now. And so I want to, before I get started with the questions, I want to give everybody a really good idea of the depth and breadth of your background in the industry. So I'm going to read through your bio and tell everybody kind of, what you've been doing for the last several decades. So you began your career in 1985, assisting in the secondary market for First California Mortgage. In 1997, you joined Tuttle and Company, and they are a pipeline risk management firm, and then later ran the secondary markets for Standard Financial. And after that, started a subprime mortgage company and ran it as the president. You worked for CMG Mortgage, director of secondary markets, RPM Mortgage, who we all know as the director of capital markets, and then eventually pursued your passion, starting this widely read daily market commentary that we all have come to know and love. And so I affectionately title that Rob Chrisman's Daily Message. Right. So Rob is on the board of directors of Inheritance Funding Corporation, Doorway Home Loans, Axis Appraisal Management, the California Mortgage Bankers Association. He's a member of the Secure Settlements Advisory Board and an associate of the Stratmore Group and the Mortgage Bankers Association of Carolinas Membership Committee. Rob holds a Bachelor of Science from Cal Poly St. Louis Obispo and an MBA from Cal Berkeley. So welcome, Rob, to our Economic and Housing Summit.
Thank you, Peter. Good to be here.
Good to be here. So without further ado, just really give us an update on Myrtle. So what is she up to? And the question you can kind of follow that, the answer you can follow that up with is, have you consulted with Myrtle on the economic, outlook?
Myrtle's pretty mum about what her thoughts are on the economy and the administration and so forth. So she's very opinion neutral. But I will say that it's fun to mention Myrtle, and oftentimes I'm asked by folks, why did you start the commentary? Why are you writing this? And the answer I have is to try to help people. Back when I was on a trading desk, they always had a need for information, and not just the information they would read in the newspaper or get from the investment bankers, but just real, actual in the street information. And so it was doing the commentary because I like helping people. And I would always throw in a dash of humor because, a spoonful of sugar helps the medicine go down, right? And the trading desk jokes were always good, whether they were, good or bad jokes. But anyway, a little bit of humor helps. And I think, Myrtle came along and so I have put her in the commentary. And when I travel around, people actually ask me, A, is she real? And she is. And B, what, why do you even mention her? What's, how's she doing? And that's, it's not like, Rob, how are you? It's, how's Myrtle? Is she real? So she is real. People who write to me and ask about her, I'll send them a photo. But she's pretty close-lipped about all of this. But she does lend an air of credibility to certain things. So it's a treat having her around. And like I said, if she wanders by, I'll grab her.
Fantastic. Well, good to know, and give her our regards.
All right.
So on to kind of the industry. One of the first questions came from one of our loan officers, branch managers in Ohio, William Dawes, wanted to know what's surprised you the most about the changes in our industry as a result of COVID. Is there anything that's kind of, really surprised you and taking you off guard?
Yes. And I'm going to build on some of the things that the earlier speakers have mentioned. When you talk about off guard, and that can be a good way or a bad way. In my case, it's a good way. And we are in an entirely different position than we were in 2008, 2010, 2012. This industry is really the hero in this kind of climate, where we are helping literally tens of thousands of borrowers around the United States. And the ability for this industry and Fairway to be able to transition from an office environment to a work from home environment, basically without missing a step, is a huge testament to IT staffs at Fairway and in the industry to be able to do that, to take a workforce of hundreds of thousands, and within a week or two, basically have everybody practically up and running, and have the consumer continue to be helped and borrowers continue to either buy homes or save money, I think is what really surprised me. The ability of our industry and of Fairway to move technology, which might have taken years to roll out in some cases, whether it's from a practical nature or whether it's through money or time or whatever, to be able to take millions of documents of helping, once again, thousands of borrowers into a situation where they didn't know that anything really had happened, and so to be able to cram all that technology change into a matter of months and to be able to continue funding loans says a lot about Fairway. And so if anything I'm surprised at, or was surprised at, it's been that. And like I say, without missing many steps and with consumer satisfaction continuing to be high. And I read the letters that borrowers send to Fairway's management, and it's just a great written record of what Fairway and the industry has been able to do. So I would say that has been the biggest surprise for me, and I mean that in a very good way.
Thank you. Moving on to kind of comparing banks to mortgage brokers to correspondent lenders, Barry mentioned earlier this morning that 52% of mortgages are below 4%. And while we anticipate the pace of refinances to slow down next year, who do you think is best positioned to capture that production?
I would echo Dave's sentiment to some extent. I think that banks occupy a unique place in our industry. Banks throughout the 1800s and into the 1900s, well into the 1900s, were the source of money. And in my parents' generation, I remember them buying a home in Saratoga near San Jose in 1967. And I asked my mom in later years, how did you pick, how did you get a loan? And she said, well, we just go to the bank. We went to our bank. We went to our bank. That was how business was done. And when they paid that loan off, that VA loan, that 6% loan in 1997, we had a little celebration and so forth. So for them, a 30-year loan was indeed a 30-year loan through the bank. banks have historically had a very broad focus. Car loans, home loans, credit cards, trust services, money management. The list goes on about the pie chart of revenue and expenses for a bank. Independent mortgage banks, we are focused on one issue, basically mortgage lending, whether that's forward or reverse. Mortgage brokers, the same situation. And through time, banks have lost a tremendous amount of market share, whether that's just through lack of aggressive pricing or through actual measured business steps. For example, Chase getting out of FHA, for example, or Wells Fargo leaving wholesale lending several years ago. They just couldn't guarantee to the government that all the brokers were doing the right thing. So independent mortgage banks, though, have a focus on lending. And I think that to some extent or to a great degree, they will continue to occupy the primary role for mortgage lending for several years in the future. That being said, when a Chase or when a Wells Fargo or when a US bank or a Citi bank decides to get back into the game, they can do so very in a big way. And their pricing, obviously, they don't have warehouse lines. They've got deposits, and I don't know what you're earning on your bank account, but mine's close to zero. So their cost of funds is very low, whereas a independent mortgage bank, their cost of funds tends to be a little bit higher. So you would think theoretically, banks would be in a better position financially to get into lending and to occupy a dominant role. But as I said, they've stepped back. Independent mortgage banks and brokers have rushed into that vacuum only too willingly and done very well at it. So I would argue that banks, independent mortgage banks like Fairway and mortgage brokers will continue to do well. They tend to be more nimble than a large bank. I know that Fairway can turn on a dime. A small mortgage broker, Peter and Rob's Mortgage, if we want to do something about our pricing, we can do so that afternoon. It's very quick. But I think that the independent mortgage banks have risen to the times and done a very good job of it. So I'm a fan. I'm also a fan of loan officers. For years, it's interesting how, as an industry, we continue to be, things come along and we conquer them or incorporate them, and then it just becomes part of our business model. 2008, 2010, horrific times. We got through that. Oh, the CFPB enforcement action. Oh my gosh, they're going to put everybody out of business. We get through that. TRID. Oh my gosh, it's going to drive everybody out of business. No, we got through it. And so right now is a fantastic time to be a mortgage originator, because for a while there was talk that the CFPB doesn't like brokers, or that the internet was going to make, we were going to go the way of Southwest ticket agents. It's all done online, and loan officers were going to go the way of the typewriter ribbon salesman or the lamplighter, the ice seller. That's not proved not to be the case. And in fact, when you talk about COVID-related surprises, what we found is a renewed appreciation of actual originators, because with all this political hoopla going on and with all the virus hoopla going on, to be able for a borrower to rely on a person to sit there and talk on the phone or on a Zoom call, or 6 feet apart at a Starbucks, or however that works, to be able for a borrower to rely on an originator's expertise and wisdom and experience has really helped in this year. And that's one of the reasons why I think customer service has been so strong, is because the borrowers have somebody to rely on. They aren't relying on the internet. They're relying on a loan officer to help them. So my 2 cents.
Thanks for that. And maybe just the next question is really about the secondary market, right? So your depth and breadth of knowledge there, what was your take on the way that this year went down, and the way that that Powell kind of, facilitated the reduction in interest rates?
Well, we'll be talking about this era for decades, if not hundreds of years. It's been one huge experiment, and one of the experiments that we saw in March and in April was the Federal Reserve coming in and stepping up. Now, if you recall, several years ago, 2008, 2009, 2007, things took months, years to devolve. 1 month Bear Stearns with, and then, WAMU, and then, Countrywide. These things, it was taking a long time. And the Federal Reserve at that point was thought of as slow to react. Maybe they didn't come in quickly enough. This time, they didn't want to make that mistake twice. And so jumped in. And I think in their exuberance, obviously, MBS prices shot up. Companies suffered margin calls and had to pay money to broker dealers to make up that difference between where they sold a security at, where they might have to buy it back. And of course, they got that money back when the loans actually funded and they were able to make those gains. But I think the Federal Reserve, far be it from me to sit there and say, well, they made the wrong move. I think they did what they thought they needed to do at that time. And they also found out very quickly that things are good in moderation and perhaps should not have jumped in as quickly as they did. And they've maintained a pretty moderate balance in terms of asset purchases since then. You also have a lot of people out there in the capital markets saying that the Federal Reserve should not be buying as much as they are, or should scale back the Federal Reserve's purchases because they are supporting interest rates. I think there's some credence to that. And the results yesterday, the press release and so forth, showed that they will continue to be buying into 2021. I think at some point they will start to scale that back a little bit. But for now, I think that the stability that they have lent the industry over the last 9 months has been very much needed, and probably will be into 2021.
Great, thank you. I think Sarah's got a question.
Yeah. No, this is for Rob. Rob, this is from Amy Simmons. She's out of a hot market, Chandler, Arizona, and a shout out to Amy. She's out of RJ Kellen's branch and doing incredible this year. So Rob, you've been around a long time. Me too. Jake has too. We've been around a very, very long time. And her question is, because you've seen a lot of markets. I was thinking back on, I've probably seen, I don't know how many cycles you've seen, but I think I've seen 6. So what's the turning point for this hot market? Is there anything that could bring the hot market to a halt? So that's a big question.
Well, and welcome back, Sarah. I'm glad you got glad you got the
potato chips.
I'll tell a story, a quick story. So my son was transferred to Salt Lake City a few years back, and he has a business degree from the University of Texas, and he looked at the cost of rent in Salt Lake City and the cost of buying a house in Salt Lake City, and said, I'm going to be paying rent that's going to be $300, $400, $500 a month more than a monthly payment at today's interest rates, and so I'm going to buy a house. So he bought a house. Hats off to him. And he sold that house earlier this year and made a little money, and is now renting. He's moved to San Diego. It became a non-owner occupied house in Salt Lake City, but now he's living in San Diego. And I think that he regrets not being still in the housing market. When you look at the housing market, whether it's Chandler, Arizona, or Phoenix, Arizona, or Las Vegas, or the Bay Area, or Denver, wherever, there are 3 main things that originators need to keep in mind what's going on. The first is COVID. All right. The home has this new sense of identity, a new place, a renewed vigor in terms of being at home. And so that is going to continue for a while. The second thing is low interest rates. Low interest rates are expected to continue for a while. And then the third thing for people to keep in mind is that the demographics, the millennials, there are 73 million people age 24 to 39 or something, And for a while there, we were concerned as an industry, yet another concern, versus TRID or whatever. Will the millennial ever want to buy a home? Well, I would tell people, of course, they're going to want to buy a home. It's just a matter of time. How many homeowners are there that are 22 years old? So as they've gotten into their 30s, the demographics point to continued demand for housing. So I know the saying is no tree grows to the moon, but I love I'm a property owner. I like being a property owner. I think anybody who's not a property owner right now, who doesn't have a good reason not to be a property owner, is regretting not owning a home. Now, granted, owning a home takes away some of your flexibility. Maybe people have not been able to save up money for a down payment. But home ownership, I don't see as a fad going away. And in fact, I only see it increasing in demand. One of the interesting things that I think listeners should pay attention to is it's relatively easy to talk about, oh, we need more housing units, or we need to do this, or we need to do that. But as originators will tell you, and as builders will tell you, all real estate is local. And so it's one thing we need more houses, or we need to improve home ownership or affordability, but to actually get that done at the local level, for builders to work with the county or the city, or with zoning ordinances, or with people who already live there saying, not in my yard, not in my backyard. That kind of mentality there's a disconnect between some of the national measures that happen and some of the county and city measures that promote ownership. So I think we're going to have this lack of supply for quite some time, just at the time when the millennials want to buy homes. And so I just don't see, I'm a buyer of houses. And I think when I talk to friends and neighbors and so forth, or other people, and they'll say something like, well, I'm waiting for the next foreclosure crisis. I'm waiting for the next big economic downturn because, we want to buy a vacation home in, Louisiana, or I want a second home up in the mountains or I want to buy a non-owner occupied house. There's a lot of money sitting on the sidelines. A lot of people have been saving a lot of money, and they want to put that to work in real estate. So I'm bullish on the sector. I just don't see prices going down measurably. And lastly, I'll take a breath after this, but lastly, remember several years ago, there were large companies buying huge numbers of homes and renting them out. Tens of thousands of homes were taken off the market and are now being rented out by some of the large firms that are out there, some of the large investors who are reaping the benefits of that. If they start to sell, if they say, well, we've ridden this as long as we're going to, and we're going to start selling some of our, tens of thousands of rentals, then we could see a dent in prices. But until that happens, I just don't see prices going down.
Fantastic. Thank you, Rob. And just for everybody, we know that you have a hard stop at 10 after the hour. So just a couple more questions for you. I noticed in today's blog that you mentioned reverse lending. And so for all of our reverse lending loan officers out there, give us your 2 cents on the baby boomer population and how it relates to a reverse loan.
Harlan, is Harlan on this call?
I hope so.
That is I've spoken at some reverse mortgage events back when you could actually speak at an event. And I'm bullish on that sector as well. You cannot ignore 10,000 people a day turning 62 years old. And a good portion of those have assets, homes that have appreciated. And a good number of those, as they get older, will want to pull equity out. And how they do that is up to them. But I think the reverse mortgage sector is kind of, it's not exactly unknown, but everybody right now is so focused on forward mortgages and refinancing people at 3% or 2.5 or 3.5, whatever rates are today, that through this all, the reverse mortgage sector continues to do well. And I think it's only going to continue to do better and better as the years go by. because people need money to live on. They may not have enough Social Security. They may not have a pension, whatever it is. And so their equity is tied up in this home, and they're not ready to move into an assisted care facility or whatever. And I'm speaking a little bit out of school here because I'm not a reverse lender. I know they have to go through some extensive counseling courses in order to become a reverse mortgage lender. And so dealing with the family and dealing with elderly and so forth. And I think well-trained, motivated reverse folks are going to do very, very well in the future. It's funny when you look at the typical reverse mortgage lender's numbers, it's like, oh, I closed 3 loans last month. It's like 3 loans, that's it. But that's a big deal when you are dealing with the amount of work that goes into each one of those loans. And like I said, counseling the family and an old person who may be hard of hearing and not quite understand things. I mean, it's amazing. It's an underappreciated part of our industry, in my opinion.
Yeah, we're bullish on reverse lending, and Harlan does a great job of highlighting and heightening awareness for us at Fairway. So thanks for your input. Some folks in the chat box are asking, how do they get a hold of you or subscribe to your blog?
A joke a day. It's just www.robchrisman.com. That's it. There's a little button there to subscribe. And the commentary goes out to a lot of people, ranging from people in Congress all the way to retired folks or out of work folks. And I send it out because I like thinking that I help people. If it can help, one originator, help one borrower, once a month, that's a good thing. I like to think it's a little more than that, but and I think that people are in this business. The money's good. For a couple different reasons. First, there's some great people in our industry, but most of all, I would say that the undercurrent or the common denominator of people in our industry, they like to help people, and they like to help people succeed. In our case, we like to help them save money or buy a home, and I think that's very important. So that's one of the reasons I send the commentary out. But yeah, www.robchrisman.com.
Well, we appreciate it. As I mentioned, it gives me a nugget almost every day. And so with that, the second most asked question that we got was, what is your favorite joke?
Oh my gosh. Well, it would have to be my Cinco de Mayo joke, which you'll have to wait until May 5th.
Oh, come on.
No.
Come on, Rob. You're going to make us wait till May. We won't even remember to ask you in May.
May 5th. The interesting thing about folks that I found is that the humor, as I said, goes a long way. And especially in our industry where people are working overtime, people are working weekends, to throw a little bit of humor their way goes a long way. And I know with the speakers that you have, Sarah and Peter on this on the session with Barry and Dave and Ivy, and then I know Mike is following me, and then Chris Whalen. There's some very heady stuff, very statistical stuff, and for originators to be able to take some of that, look at the horizon information and be able to translate that into borrower talk in order to be able to take that knowledge and say, well, here's kind of what's going on, because originators are asked about what's going on with the Fed or what's going on with politics, and am I going to be able to get a loan? And I hear this stuff about Fannie Mae and Freddie Mac and what's going to happen to me. For originators to be able to not only inform them, but maybe give them a little humor once in a while, I think is very important and shouldn't be forgotten. So I put the joke in there, and every once in a while I put some trivia in. But yeah, I like my Cinco de Mayo joke.
Well, it's really funny because everybody remembers it, and they're starting to put it piecemeal into the chat room. So, thanks, Tom Westerfield. He's on the witness protection program right now. But no, Rob, we're so grateful. We're so grateful for you.
Hold on, Sarah.
Are you going to tell a joke?
No, I'm not. But you're sitting here doing a wonderful job of introducing people and being an MC. Sarah, no one's asked you a question. I want to ask you to tell people, what are you seeing out there? What's the mood like? How are people doing?
Yeah, I mean, we hear this from Jake and we feel it on the executive team from the street. I would say, people are very fatigued. I hear that a lot. They're very, very fatigued. They're very grateful to have the year that we've had in the industry. They're just, so thankful to be at Fairway and to have the resources and the support. But the flip side of it is, they're fatigued. The other thing that continually talking to people about is to get their focus back into purchase business. They have to, because, again, everybody's got a little bit of a different take on where refi or it's going to go. And I know Dave, he was talking about the drop, and I don't know what you think it's going to be. We've heard anywhere from, it was 1.7 down to 1 for the drop. So telling people, hey, you got to get back out. You got to be working on those referral partners. You've got to diversify, right? There's riches and niches. We talk a lot about that going into reverse mortgage, going into reno. There's so much that you can do based on the lack of inventory in some of the areas. But that's what I'm hearing from the folks that we talk to on the street every day, and just encouraging them to get back out there, whatever you define as out there, depending on the state that you're in and how open you are, and spending time with your referral partners and your database, really working your database. So I don't know if that's the same for you, but that's what we're hearing.
Yeah, I hear the same thing. I think that's senior management's toughest role right now, is to be able to keep people fired up, but also know, to make somebody take a break, step away from their smartphone for a little bit, step away from the computer, especially here in the holidays.
Yeah, that's a definite charge that I'm challenging people to do, is to put their phone down for 4 to 8 hours. And it's all they can do to do that. So thank you, Rob. Thanks for being a great friend. I see Jake back on. Any comments, Jake, for Rob joining us? He's such a great friend of Fairway.
Little story about Rob for the team. We talked at the beginning of the event about how we think, and we had talked about 5.5 years ago where we lost a whole bunch of groups in a time period of, really felt like minutes. But go back to 2012, the person who both Sarah and I have known forever, Dan Kataya, who was in charge of secondary at the time, Dan decided to retire all of a sudden. And so we were left a little bit. Mike Blake was just getting started. And so we reached out to Rob Chrisman, who we've known for years, or we'd known of for years, to help consult with us and kind of get us balanced a little bit and act as wise counsel. It's that whole thing about silver lining again. So that started a relationship, and Rob's just part of us now. And, the cool thing is Fairway, not that people really care either way, but we started selling stock back to people in the company, probably 20 years ago. And of all those years, there's only 2 people outside of Fairway that we even talked to about it. One was Jerry Baker, who coached us for years, and Jerry has since retired and sold his stock. But Rob Chrisman's the only other person that has a few shares of stock of Fairway. And he's the only person outside of the company. And you say, why are you sharing that? That's how much we think of Rob. He's been, that whole 212, it sounded like, it's always that silver lining thing. At first you go, oh my gosh, that turned out to be a blessing for us. And sometimes when things happen, you don't think they are, but if you just be patient, they end up being blessings. And so we couldn't be more appreciative, and just wanted to say thanks.
And vice versa, Steve. I appreciate everything here.
All right, everybody do the wave for Rob Chrisman and Myrtle.
I wasn't able to produce Myrtle.
And Rob loves a good red. All right, Rob, thanks so much for being on with us today. You were so fun and always so informational.
Anytime.
You should be reading Rob. Part of our coaching from Fairway Ignite is read Rob's blog every single day.